Good morning, everybody. Thank you for joining me today. My name is Mitch Young. I am the Director of Fusion Consulting, and we are Life Residential's preferred tax partners. We assist a number of their landlords with their UK tax compliance. We work seamlessly to ensure that deadlines are met and that our clients are structured tax efficiently on a year-by-year basis. Today's webinar is primarily focused around property taxation in the UK. We're going to cover a number of changes and updates to how landlords are taxed in the UK and some compliance points. You will see the webinar allows us to type in some questions. So if you do have any questions as we work our way through the webinar, then please feel free to type them in the question box, and then I will get my way around to them towards the end of the webinar. So here is our agenda for this morning. So we're going to talk about the changes to mortgage interest. This has significantly affected a number of landlords and has led to significant increase in queries to us around property structuring and planning for the future. We're going to look at some other small changes which you may not have been aware of. Obviously, the mortgage interest and stamp duty are two of the highlighted changes, but certainly there's a few other changes that may have been missed, so we'll talk about those. A lot of our clients are non-UK residents, so it's important that we consider the latest changes to how non-UK resident individuals are subject to tax in the UK, in particular capital gains tax. So we're going to look at that. A lot of clients are asking us, shall they incorporate their buy-to-let portfolio? And that means, can they or shall they move their residential properties that they own in their individual names into a limited company? So we look at some tax implications of doing that, whether that's a good idea or not, in a bit more detail. We're going to have spend a few minutes on a landlord's responsibilities towards HMRC on a year-by-year basis. We're finished with a little known disclosure amnesty available to all landlords. And then I'll just let you all know a bit more about what we do, and then answer any questions that you may have throughout the webinar. As you'll see along the bottom of my lovely prepared slides today, that anyone can arrange a free 15-minute consultation with myself after the webinar has finished. If you just drop me an email, my email address is along the bottom of each slide. It's mitch@fusionconsult.co.uk. So feel free to email me either with your queries if they are bespoke, or indeed just to book in a free 15-minute consultation whereby I'll call and answer your questions and introduce ourselves over the phone. No problem at all. So as we've seen, there's been a number of changes to tax rules regarding residential property recently. There's 5 key areas that have been hit very badly. The first is, as we know, landlords now pay 3% more stamp duty land tax when they acquire additional buy-to-let property. Now, there's a lot of legislation around that, and we often have clients asking us, is there a way that they can mitigate this? And it is very difficult. Even if you own an overseas property and you're going to purchase another property, then the 3% additional stamp duty will apply. Husband and wife, the same thing. You have to obviously take into account that consideration and that extra cost when looking at purchasing additional property. But the main area we're going to focus on in this slide is that from the 6th of April 2017, individuals have started to lose the higher rate tax relief on their buy-to-let mortgage interest. The government are essentially restricting the amount of income tax relief on buy-to-let interest so that landlords of residential property can only get the basic rate of income tax on their interest. This restriction is being phased in over the next 4 fiscal years, started last tax year in April 2017. And what this means is that from a practical point of view, if we take an example of, let's say, you may have a rental income annually of £10,000 and your mortgage interest is £10,000. Historically, on your tax return, what you show is the profits. So you have your £10,000, you deduct the £10,000 of mortgage interest, you declare no profit and no tax to pay. Now, when this change comes fully in the year 2021, what you'll have to show on your tax return is the full rental income of £10,000, and you won't be able to deduct the mortgage interest in the first stage of the computation. So you'll have your £10,000 and that will be taxed at your tax rate. Then you'll only be allowed to deduct from that tax position a 20% basic rate tax reducer. And that is how the mortgage interest will be taxed working through the tax computation. So essentially, if you're a higher rate taxpayer, you're going to have an additional level of tax to pay on these fake profits. So essentially what you'll need to do is plan out the next 4 years and work out the tax position, because what we found in practice is that a lot of clients don't actually realize the practicalities around working out the profits from a tax point of view, and then they're going to be subject to quite a large tax bill, and therefore they need to plan accordingly on whether it's worth keeping their residential property or selling it, or selling it to buy a series under a limited company. But certainly over the next 4 years, you should all prepare, tax illustrations so and can expect a tax liability. Who's affected by this? So it's any residential property landlord who has borrowings relating to their residential properties. It only affects individuals and partners, and it does not affect companies. So any limited company that is owning residential property that has lending, that can be 100% deducted against the rental income. Hence why I've spoken about at the beginning, a few landlords are deciding whether it's worth moving their residential property into a limited company, purely because they're so highly leveraged. It may make sense from an initial income tax point of view. I mentioned that it's treated as a tax reducer. So what that means, as mentioned, is that you're taxed on the rental income, and then the mortgage 20% element is deducted at the bottom of the tax computation rather than the profits. It's also worth noting on this point that borrowings from an HMRC legislation point of view doesn't only relate to mortgages. It also relates to loans and loans to buy or improve, renovate property. It's not restricted just to a mortgage. So it's important just to be aware of that. And here you can see the table which illustrates how the tax deduction is happening over the next 4 fiscal tax years. So you can see the current tax returns in which we're preparing at the moment. So the tax returns for the period ending April 2018, you're still allowed to deduct 75% of the mortgage interest against the rental income, and then 25% of that figure will be treated as the tax reducer element. And then it goes down accordingly until it's fully in place in the tax year 2021. Essentially, you'll need your tax advisors to calculate this via their software, and then to explain the calculation in greater detail for you. So just moving on to some general tax changes. So the first one is regarding the first one is regarding the wear and tear allowance. This is previously it was a nice allowance for landlords who were renting furnished properties. Furnished property is, where you're renting it with furniture, beds, equipment, curtains, cookers, etc. And previously, you would get a deduction against the rental income of 10% of the gross rent. So for a lot of landlords, they used to rely on this deduction because it used to be a nice amount, 10% of the gross rents to be deducted, which obviously reduced the profits and then reduced the tax. Now, HMRC abolished this from April 2016, and instead they replaced it with essentially you're allowing to deduct the actual cost of replacing of furniture. So furniture and furnishings, I guess, include things like televisions, fridge, carpets, linen, beds, movable furniture in a property. A lot of landlords may say, well, they haven't actually replaced any of these furnishings, so it doesn't help them. But that's essentially the change. And again, it may affect the profitability of each property and therefore an increased amount of tax. So just be aware of that. Some other points here is the rent of room relief has increased. So it's essentially it's a relief of income tax available for any landlord or occupier of a property who lets a furnished bedroom in their main residence. Essentially, they have an additional allowance similar to a personal allowance, whereby they can earn up to £7,500 of income from the rent of that room, tax-free. So that may or may not affect you, but there's a nice relief that's available. ATED. So the ATED it stands for the Annual Tax on Enveloped Dwellings. This is an additional tax and an additional level of compliance which concerns a company that own residential property. The government brought this in a few years ago, whereby they were going to tax any envelope dwellings, any corporate vehicle which is owned residential property, and you're renting it out, or you're having a family member or someone close connected to you or the company live in that property, because it historically was a way to plan very efficiently for tax purposes, certainly for non-residents or non-domiciled individuals. When it was first brought in, the tax was on the value of the property. So when it was first brought in, there was a tax charge annually for any company owning residential property that was valued above £2 million. Every year, the company would have to pay a tax charge ranging between £3,500 going up to £20,000, depending on the property. And they'd also have to submit an additional tax return, an ATED tax return every year. Each year, the government has reduced the value cap of these properties. So now the value cap is at £500,000 as of April 2017. So this means that if you have a company that owns a residential property in the UK and the value of that property is above £500,000, you have a responsibility every year to submit an ATED tax return. The property has to have been valued as of April 2017. And then on top of that, there's an annual charge. So for properties that are valued at £500,000 to £1 million, there's an annual charge of £3,600. If it's valued at £1 million to £2 million, the annual charge is £7,000. If it's valued at more than £20 million, then the annual charge is over £200,000. There are a number of reliefs available. Now, the biggest one is if you are commercially renting the property to a third party, then you don't have to pay the annual tax charge, but you still have an annual responsibility to submit a tax return. You need to claim the relief on the tax return. So this is the case in most people's situation. They've owned a residential property for a company. It's valued at more than £500,000, but it's rented to a third party. So they just need to complete the annual tax return and claim the relief, so there's no additional tax charge. Failure to submit the tax return results in the usual type of HMRC statutory penalties. Again, if you are renting or considering purchasing property through a limited company, then please feel free to get in touch with me to discuss ATED in greater detail. Now, of course, we've touched upon the stamp duty issue and the additional 3% tax charge. There is a hell of a lot of information out there on and HMRC guidance. What I suggest is, if you are concerned or there's a grey area around stamp duty, in particular the qualification of main residents, first-time buyers, or whether you believe you will qualify for the additional 3% stamp duty, have a look at the HMRC help sheets, which I can send round, or if not, please get in touch and I'll help you interpret your situation. Most cases that I've spoken to, when there is an additional property element, when the client has a property to begin with which they own, if on the date of when they complete the second purchase they still own the first property, then more than likely they qualify for the additional 3%. Just a couple of interesting stats to break up the presentation. Right, moving on, non-residence and capital gains tax. So, sorry about that. As of last year, HMRC changed the legislation regarding a non-UK resident who owns UK property. Now, if you are a non-UK resident who sells their UK property, you are subject to capital gains tax in the UK. And not only that, there's some additional compliance points. So the first is that you will have 30 days from the date of the sale to complete an additional tax return. The additional tax return is called the non-resident capital gains tax return form, and it needs to be completed, 6-page document. There's a few complications on that, which I'll come on to, and submitted electronically to HMRC within 30 days. Failure to submit that tax return within 30 days results in an automatic £100 penalty. So it's very important. If you have sold property and you are non-resident and you haven't done this form, then let me know, and the sooner we can get that done for you, the better, because there will be penalties. Not only that, you will have to complete the usual self-assessment tax return as well as this non-resident capital gains tax return. So there's 2 tax returns in the year in which you sell the property that need to be completed to HMRC. However, there is some good news. The good news is that as a non-UK resident, HMRC have said that you have the option to rebase the original cost of the property to the market value price as of April 2015. So what this means, let's take for an example an individual who may have purchased a flat in London in 1990 for £10,000, and then they sell it today for £1 million. That individual is thinking, I'm going to have a huge gain, £990,000 to pay tax in the UK of. But they may not know the new rules regarding this. And if the value as of April 2015, let's say, was 900,000, then on this capital gains tax return form, they can elect for this method and only be subject to the gain between the value of April 2015 of 900,000 and what they sold it for at 990,000. So instead of being subject to tax on nearly £1 million, they're only subject to tax on the £90,000. You can elect for the usual methods of taxation if it's more tax efficient. The individual will have the choice, but obviously it's a very good favourable rebasing for a non-resident individual. So bear that in mind when you're thinking of selling, or if you have sold. Okay, so we've briefly touched upon a number of different areas. The main one regarding the lending and the interest relief. And as I mentioned, that when you own a limited company, you can still deduct the mortgage interest. So a lot of landlords, and I probably get at least, one query a week at least on whether a client can move their residential portfolio into a corporate vehicle. And there are a number of implications that one needs to think about. The first one is the capital gains tax position. So if you have an asset, say a property as an individual, and you are going to give it away to a new entity, i.e. a limited company, that creates a capital gains tax position. And the capital gains tax position, strictly speaking, is on the gift, what you paid for the property less the current market value on the date of the gift. There may be reliefs available depending on circumstances or not, but essentially if you are just gifting one property to a limited company, then there is likely to be a capital gain tax to pay on that gift, and that will need to be reported via a self-assessment. So that's something that you need to consider and work out. Now, there is a capital gains tax relief called incorporation relief. This is where you are gifting a business into a limited company, hence you're incorporating a business, and at that point you can roll over any capital gains. So we're doing a lot of analysis on whether a rental property business can qualify for incorporation relief. And the key thing here is whether it can qualify as a business. There's a significant amount of case law regarding this, and a lot of analysis needs to be done. I would say if you have one property and you want to move it into a limited company, one rental property, it's almost impossible, highly unlikely you could claim incorporation relief. If you are an individual that has 10 properties and that is your full-time position in terms of managing those properties, you spend significant amount of hours in running that business, that's your main source of income, you don't have any employment or any other sources of income, then I would argue that there's a strong possibility you can move all the properties into a limited company without any capital gains tax, because it could qualify for incorporation relief. Obviously, sometimes it can be a grey area, like the majority of tax, it's down to interpretation, but there is a clearance facility, non-statutory clearance, that you can write to HMRC and ask for. But that's just the capital gains tax. What about the other taxes that need to be considered, and the other positions? So the first is, okay, you have the properties into a limited company, and that's good because you can you'll only be subject to corporation tax rates in the UK, which are 19%, decreasing down to 17%, and that's it. Possibly additional tax when you take out the monies. But what if you're buying and selling property? You know, if you plan to sell some of these properties and get the money out, then you'll have to pay corporation tax on the profits of the gain that you make. And then if you want to take the money out, you're going to have to pay additional dividend tax on that withdrawal. So if you are buying and selling the property, or future plans to buy and sell property, then it may not make sense. Another area you need to consider is the stamp duty position. If you are moving the properties in with lending, then potentially there's going to be a stamp duty charge, and you need to work out the tax effect of the stamp duty cost in moving it into a property over the eventual income tax savings. And then the final, well, there's a few more points, but the final point for the purpose of this is, if you have mortgages in your individual name, so let's go back to the example, if you have the 10 rental properties and they're all in your individual name with mortgages, move it over to a company, you'll need to change the mortgage into a limited company name. What is the cost of doing that? what are the exit charges on your existing mortgages, and can you work something out? Essentially, what needs to happen is you need to have your tax advisor produce a report, if you are thinking of this, which analyzes all the different tax effects of moving it into a property over keeping it in your own name, and every single finance cost needs to be available, and then you can make an educated decision, because there's so much involved, so many different taxes, that you can't just make a decision just off a conversation. You need to do some actual tax analysis and computations. Okay, so moving on to a landlord's UK tax responsibilities. So every year, if you rent out property in the UK, you need to be submitting a self-assessment tax return. This is due electronically and can only be submitted electronically. If you are a non-UK resident, and you are trying to do it by yourself, then you could face difficulties because HMRC restricts the software from a number of international countries. So that's why we act for a number of international clients to manage this process, because it has to be done electronically. The tax returns have to be submitted by the 31st of January, and the tax paid on the 31st of January, and if you have payments on account in July. The tax year in the UK runs from April to April, and always the submission deadline is a year behind the actual tax year that we're in. So, for instance, the tax returns that are due in by the 31st of January 2019, so they're the current tax returns we're working on, is for the tax year ending 5th of April 2018. If you are a non-UK resident and you are renting out UK property, you can complete a non-resident landlord form. This form basically enables you to choose to have tax deducted at source or not. Essentially, this form gets sent to HMRC with your managing agent's details, and then HMRC writes to the managing agent to determine whether they should be deducting 20% tax off your rent, and then that gets paid over to HMRC, or you leave it to your own devices. A lot of clients believe that because they've completed this non-resident landlord form, they do not have to complete a self-assessment tax return. That is incorrect. Okay, the non-resident landlord form is purely just to determine whether you are having tax deducted at source on your rental income from the managing agent or not. That is it. Just because the tax is being deducted at source doesn't mean you negate the responsibilities to submit the annual self-assessment to HMRC. Okay. So that's a very important point. Selling a property, you will be subject to capital gains tax, and that will be again documented via your annual self-assessment tax return form. And again, any relief that you may or may not be entitled to will be claimed on that form. Another point is on the allowances. So if you are a UK citizen, i.e. a UK passport holder, you will be entitled to a personal allowance. So that's a tax-free income allowance of £11,700. Depending on which country you are resident, you may or may not be entitled to a personal allowance. So it's important to check. We can check the double tax treaty agreement with the UK, and that will determine whether you're entitled to a UK tax-free income allowance. Same thing applies on the capital gains tax side of things. When you sell a property as a British citizen, national, you're entitled to a capital gains tax-free allowance of again 11,000, and it will depend on the double tax treaty and the country in which you're in whether you will qualify for that or not. So, check again with the tax advisor the double tax treaty and whether you're actually entitled to that or not. And allowable expenses, just very briefly, you can claim against the rental income, aside from the mortgage interest, obviously, which we spoke about, any allowable expense incurred in the running and maintenance of the rental property. So these are things like the cost of your managing agent, the cost of your tax advisor, it may be some repairs, maintenance, insurance. For some landlords, it could be travel. If they're traveling a long way just to come and view and deal with the property, you can claim a proportion of the travel. You need to be careful in claiming things that can qualify for capital expenditure. So these are things like the replacing of a kitchen to a brand new kitchen, or upgrading a new bathroom. These are classified as capital of nature, and you can't deduct that cost against that year's rental income. These capital costs get deducted when you sell the property against the capital gains tax in the capital gains tax computation. So revenue distinguish between the revenue costs and the capital costs. So it's important you just are aware of that, so you're not expecting a big income tax loss because you've made some huge renovations on the property, where actually it will be deemed as a capital of nature and therefore that cost saved until you sell the property. Quite often we deal with clients who have said the following things. Our rental income is below our personal allowance, so I've never submitted a tax return. Or they said, I've completed a non-resident landlord form, so I've never completed a tax return. Both of these situations, there is still a requirement to complete a self-assessment tax return. Failure to complete a self-assessment tax return results in automatic penalties of up to £1,500 a year. Those are just the statutory penalties. Furthermore, HMRC now have significant amount of information on landlords. So they have the letting agents and managing agents that are giving HMRC information. All the banks are giving HMRC information on lending. They have access to land registry. So we are seeing more and more penalties being issued, more and more tax investigations being issued to clients worldwide. There's an exchange of information globally for individual landlords and people owning property in the UK. However, there's some good news for any individual whose tax affairs aren't up to date. There's a little known disclosure called the Let Property campaign. This is available to any individual who owns UK property, no matter where they are in the world, and has never submitted their tax return. Essentially, we can register them for this campaign. They then get a reference number, and from that date, they have 90 days to bring their tax affairs up to date via the form of this disclosure. It's essentially a big document where you complete every single tax year that's historically outstanding, and you submit it to HMRC. You pay any outstanding tax that's due. The benefit of doing this is a number of things. The first is that once you're registered, HMRC cannot open up an investigation into those tax years. 2, they can't request any tax returns or issue any statutory penalties. 3, you get a reduced capped penalty of 10 or 20% of the outstanding tax. 4, no criminal prosecution. And 5, it's complete peace of mind. We have helped hundreds of landlords across the world bring their tax affairs up to date. Where the client has had no tax to pay, we've been able to negotiate with HMRC no penalties. We've had a client 15 years worth of tax returns outstanding, 10 property rentals, and because of losses brought forward, there's been no tax to pay and therefore no penalties. So it's a great disclosure. It's a great facility to any landlord that needs to bring their tax affairs up to date. And we've successfully done this for hundreds of landlords. We have a great relationship with HMRC in this specific department. And if anyone would like to discuss that in greater detail, please email me and we can discuss. The final point on this is that these disclosures can be withdrawn at any point with HMRC. So I would highly recommend it. Okay, so thank you very much for listening. Just a couple points about Fusion. So we are international tax advisors. We're a team of international tax advisors based in London. We act for a number of landlords in conjunction with Life Residential. We have a specific agreed price with Life Residential of £50 a month, and that includes acting as your tax advisor for the year, completion of your tax return, dealing with any requests. It also includes tax fee investigation insurance. So if ever you were investigated with HMRC, our time spent in dealing with that would be covered. Because we're working in partnership with Life Residential, it's a seamless approach, and they provide us with all the rental information to produce your tax return, and the £50 gets deducted from your management account with Life Residential, so you don't even see the money out of your bank account. So it's quite a seamless process. Again, happy to discuss that with everyone. We also do bespoke tax advice, so be it, as mentioned before, property tax structuring, whereby we produce a written piece of tax advice for you. We do inheritance tax planning. We also have a wills and legacy division. And any bespoke tax advice you may need or require. We're a team of qualified tax advisors and chartered accountants, so we can assist with general accounting as well. And happy to offer a free 15-minute consultation to anyone on this webinar, or feel free to get in touch, email me your queries, because when it comes to UK tax and property, there's a lot to be aware of on an annual basis to ensure that not only that you're compliant, but also that you're tax efficient. So that concludes today's webinar. No doubt I will be back again next quarter, hopefully with a tax update. And as I said, you can even write yes in the chat box if you want a free consultation, if you don't want to email me, but there's our details. Thanks very much for listening. Any feedback as well appreciated, and have a great afternoon.